Hey everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about your retirement withdrawal strategy. Now, this is a topic I've talked about many times here on the YouTube channel. In fact, it actually continues to be one of our most popular topics. But in today's video, I'm going to take it from a completely different angle. I'm going to back it up all the way to the beginning and talk about how your retirement withdrawal strategy is actually impacted primarily by where and how you save your money for your retirement. So in this video, I'm going to talk about some of the common mistakes that people might be making as it pertains to where they're saving their money for their retirement, maybe some opportunities that some of you could be missing out on. So we're going to get into a lot of detail about that as well. But I also wanted to share with you real quick before I get into that, a story here. Recently, I had somebody call the office. They were interested in doing some financial planning with us. And as we're starting to learn a little bit about what they wanted to get out of the financial planning process, started to uncover that they had already made several key decisions as it pertained to their retirement. And these decisions were ones that could potentially impact that retirement withdrawal strategy down the road. For example, they already turned on their Social Security benefit. So that's one of the key components that we use in our strategy. And when we decide to turn on somebody's Social Security benefit can have an impact on how they're going to meet maybe some of those retirement income gaps, and also what it could potentially mean for income taxes, either higher or lower income taxes for that individual down the road. They had also taken a lump sum pension option as well. So that's something that I would have liked to have done a little bit more exploration on through the financial planning process to really find out what was the best decision. And it was really, something that we couldn't make that determination right from that phone call, but that's again why we do the financial planning, is to kind of learn how some of these decisions that you make could impact that retirement withdrawal strategy down the road, maybe some of the potential income taxes. So that's one of the primary reasons that I wanted to make this video, kind of back it up all the way to the beginning. And really, this is stuff that needs to be looked at very early on as you start to save money for retirement. In fact, the earlier you can start to make some of these decisions and plan out where and how you're saving the money, I think the better off that you're likely going to be. Sometimes it's in your 20s, 30s, and 40s where you're making some of these decisions, and are you putting it into a Roth or a traditional bucket, and are you taking advantage of all these different types of accounts, not simply waiting until that moment right before you retire to then explore, okay, this is what I've done and how can I make the best of it. So anyway, I hope you find this video useful. We're going to dive in and we're going to start to look at a couple of the key different spots that you could be saving your money for your retirement. Okay, so the first thing I want to talk about here is I want to talk about the two primary buckets or ways that you can save money for your retirement. The first type is what is called the traditional bucket, and that's money that generally goes into those accounts on a pre-tax basis. So you don't pay taxes today, but you do pay taxes down the road when you go to withdraw those monies in retirement. And you pay those taxes at your ordinary income tax rate. And then that's versus the Roth bucket, of course, and the Roth accounts are ones that you pay taxes on that money today before the money goes into those accounts, but you enjoy the luxury of being able to withdraw those monies in retirement completely tax-free. So they both have their advantages and their disadvantages. So one, we're paying taxes today and getting that tax-free in the future. The other one, we're getting a tax deduction today, but we're going to pay taxes in the future. So as we start to look at this and we look at the way a lot of people have their retirement accounts situated right now, I would say that with most of the people we see, they have the bulk of their retirement savings in this traditional bucket. That's because they say, hey, I'm likely going to be in a higher income tax bracket now than I will be in retirement. And what we find as we start to do the financial planning for many of our clients is that that's just simply not the case. In fact, that might be one of the biggest retirement myths that exists out there, is that I'll be in a lower income tax bracket in retirement than I am today. And deciding, or trying to determine, I should say, whether you're going to be in a higher or lower income tax bracket in the future versus where you are today is probably the number one thing in determining where you should be saving your money, if you should be saving it in a traditional account or a Roth account. So let's take a look at this. And let's look at a little bit about where the income tax rates are today. So here in 2020, one thing we know is that we're under this recent tax law change that happened in 2018 called the Tax Cuts and Jobs Act. And what we're looking at there is on the right are those new income tax tables that were created as part of that Tax Cuts and Jobs Act. On the left are what the income tax tables looked like back in 2017, the year before this went into effect. And what we can see very clearly here is that the income tax rates as we have them today are pretty much across the board substantially lower than they were back in 2017. So one thing that we know is that those Tax Cuts and Jobs Act rates are set to expire at the end of 2025. So beginning 2026, we're going to revert back to this 2017 table. Of course, it'll be adjusted for inflation up a little bit, so those numbers will be a little bit higher in terms of the brackets and everything, but we're going to go back to those old rules. And so this is something very important to recognize, and to recognize where we fall in this income tax bracket today in terms of our taxable income, and maybe where we might be in the future on this old tax rule rate, on the 2017 rates. We also have to think a little bit about, in my opinion, the government spending, especially some of the recent government spending that they've put in regarding some of these stimulus bills. So for the past 4 or 5 years or so, we've been racking up nearly $1 trillion a year in an annual deficit. And that's just been stacked on top of the existing debt that's out there. Here in the last couple of months here, we're in May of 2020, the government has spent $2.4 trillion in additional stimulus. The Federal Reserve has substantially expanded its balance sheet. It's a little hard to get a grasp of exactly what the Federal Reserve does with their money, but they have drastically expanded their balance sheet. And at some point, do we maybe say, hey, our tax rate's going up, and we know in 2026 they're going to go back to this level here, but is it possible, or probable, I should say, that income tax rates might go up even more in the future? And that's one thing that we want to think about here as we're starting to put together what eventually will become a retirement withdrawal strategy. But again, it begins with where we save that money. And so if you want to look at where you are in that income tax bracket and compare it to where we think we're going to be in the future, in my opinion, I think one of the big mistakes that a lot of people might be making right now is not looking at the Roth enough. They might be incorrectly assuming that they're going to be in a lower tax bracket in retirement than they are today, and that's why so much money goes into traditional buckets. So we're going to explore this a little bit more, and I'm going to talk about some of the limitations and some of the thresholds that might make sense for us to understand a little bit better as we're starting to put together some of our contribution strategies here going forward. Okay, so to clarify this real quick, if you think you're going to be in a lower tax bracket in the future than you are today, then it probably makes sense to make those contributions to your traditional retirement account. But if you think you're going to be maybe in a higher tax bracket in retirement than you are today, then it might make sense to do the Roth contribution. And the last thing I'll say about this too is also don't forget to include your state income taxes in there as well. So for example, we're here in the state of Michigan. We have a state income tax rate of 4.25%, kind of in the middle of the road there as far as state income tax rates are concerned. But if I'm planning on moving to Florida when I retire and they have a 0% state income tax, well then I need to kind of calculate that in with my assumptions here and see that, okay, I might be in a lower tax bracket because I'm moving to a state that has a lower or no tax rate there. So make sure you're including that. And really the best way, again, kind of put our plug in for our Wealth Vision financial plan, but that's really why we do the financial planning that we do. It's cash flow based, but it has the ability to kind of map this out over a long period of time so you can see, where those retirement gaps are, but also see what those projected income tax rates are based on a number of assumptions that we put into the financial plan. So anyway, hope that makes sense. Just wanted to provide a little bit more clarity on that point. Okay, so now let's talk about some of the options as to where you can start to save some money for retirement. Before I do that though, I wanted to just kind of provide a little bit of a refresher on what I call the 3 primary tax buckets. And so the first bucket, of course, is what we call your non-retirement account. And that's going to be money that you have to pay taxes essentially every year on. And you can think of that, you get that 1099 every year at tax time for your interest income, your dividends, your capital gains, long-term, short-term. And so that's going to be one area that we want to focus on. And I think that's one of the areas that sometimes we see mistakes being made where people start to accumulate kind of an excess amount here in this non-retirement bucket when they could have, or maybe could be saving more money in one of these more tax-advantaged accounts. And then to kind of continue on with that, we have our traditional bucket. And so again, that's money that is going to go in on a pre-tax basis, but it's going to be taxed later. And then you have your Roth bucket. And then I'm going to, just for today's video, I'm going to add a 4th bucket in here because I want to talk about that. And I think that's one of the other key areas that people might be missing out on. And that is an HSA, which is kind of, I think, out of all of these different options, may offer some of the most advantageous tax benefits. So one thing that we know, healthcare expenses are one of the fastest growing expenses that exist out there. In fact, JP Morgan does a really great conference on this every year. They put out a really nice report, and they've been estimating for the past several years that we need to plan on about a 7% annual increase in our healthcare expenditures, whether that's the healthcare insurance or the copays and prescription coverage that we have before Medicare kicks in, or even looking at what Medicare expenses have grown over the past 5 or 10 years or so. 7% is about the average increase that we're seeing on this every year. So an HSA is available to those individuals that have a high deductible medical plan. So you have to check with your plan providers and make sure that you have a plan that supports this. But an HSA allows you to put money in, and we get something that would be what we call a double tax-free. So we get a tax deduction on the contribution going in, but also if it's used for a qualified medical expense, we can pull the money out tax-free as well. So it's one of the most advantageous areas, and for 2020 here, you can contribute if you have a family plan or 2 or more individuals, you can contribute up to $7,000 per year, or if you're a single individual, you can do $3,500 per year into your HSA. And so one strategy, as we're looking at this, we know there's going to be healthcare expenses in retirement. So number one on the list in terms of saving money for your retirement, really, I think, in my opinion, should be that HSA. And you should be fully maximizing that because of its double tax-free advantage. And then the second area that we want to look at is we want to look at, again, understanding, what your future tax rate is going to be versus where your tax rate is today. And then more than likely what you're going to do is you're going to start to fill up these other buckets. And I would say if you're not strongly considering the Roth, again, we talked about why taxes might go up more in the future, but unless you're pretty confident that you're going to be in a lower tax bracket in retirement, I would highly encourage taking a look at a Roth account. And so again, if we look at the different types of accounts, we've got your 401k. You can contribute directly to a Roth IRA. I'm going to talk about some of the limitations on that in just a second. And so you can put money into to a Roth account there up to those contribution limits. So let's talk a little bit here about some of the mistakes or some of the areas that people might be missing out on. So let's begin with the 401k plan. So the 401k is probably the most popular mechanism for saving money for your retirement. And now, fortunately, most 401k plans do offer a Roth or a traditional bucket. And again, you want to make sure you're putting it into the right area there. But there are some very generous contribution limits that are available there. For 2020, you can put in up to $19,500 into your 401k plan. It could be Roth or traditional, however you want to split that up. Unfortunately, you don't get $19,500 in a traditional and another $19,500 in a Roth, but however you want to split that up, you could put $19,500, and that's for individuals that are under the age of 50. And if you're 50 years old or older, you get an extra $6,500 catch-up contribution, which allows you to put up to $26,000 per year. And so that probably for most people watching this should be one of the first areas that you fill, basically in terms of your retirement savings. It's very easy to do. It's payroll deducted, so every pay period you just have an automatic amount that's put into the 401k plan. Hopefully, if you're one of the individuals that is lucky to have a match, you might get matched on those contributions up to certain thresholds as well. So there's a lot of advantages to the 401k plan. One thing that may be a little bit missing from a 401k is just the breadth of options available to you. Most 401ks are a little bit more limited, but beyond that, there's some, the most lucrative contribution limits are going to be within your 401k plan. And then beyond that, if you still want to save money for retirement, maybe you're trying to catch up, or maybe you're really into that, or you have excess money over and above what your cash flow needs are, then you can save money in a couple of different areas. What most people do, and this is probably one of those mistakes that I see people making, is they hit the contribution limit. Maybe they do the $26,000, and maybe if they're married, maybe their spouse is doing that as well. Maybe they're doing the HSA, but again, I think that's one of those areas that is underutilized there by a lot of people. And they say, okay, I've already maxed out my 401k plan. I make too much money to contribute directly to a Roth. I don't qualify for making a traditional IRA contribution. So I'm going to put that money over here in my non-retirement bucket. And so we see this all the time. That's why I really wanted to make this video, is because many of the people that are coming to us doing the financial planning are people that are very close to retirement, and they've already done this for the past 20, 30 years, multi-decades, putting money into these accounts. And now we're trying to optimize what they have. But really, we met them 5 years or 10 years or 20 years earlier, we could have been helping them map this out a little bit differently. Because what I think is there's a lot of opportunity being missed where people are putting money into these non-retirement accounts. It's, again, money that you have to pay taxes on every year and missing out on some other things. One thing we've talked about in some other videos is a backdoor Roth IRA strategy. So if you make too much money, you will not qualify for making a contribution directly to a Roth IRA. So for 2020, if you make over $196,000, if you're married, filing a joint tax return, or if you're filing a single tax return, if you make over $124,000, you can't make a contribution directly to a Roth IRA. So what are some options there? So one option is what we call the backdoor Roth IRA strategy. So if you don't have any other existing IRA accounts, maybe all your money is in a 401k plan, you can contribute money directly to a traditional IRA account. Everybody, regardless of income, qualifies for that, and then immediately convert that over to a Roth IRA. And it's a way to get money into a Roth IRA account even if you're over those income thresholds. So why I say you can't have any existing traditional IRAs is because of something called the pro rata rule. So let's say you rolled over a 401k a couple years ago, and now you have $100,000 sitting out there in a traditional retirement account, and you want to try to implement this backdoor Roth IRA strategy of doing maybe your $6,000 contribution to your Roth IRA this year. So you do your $6,000, you contribute it to, maybe even say, hey, I'm going to be clever, I'm going to put that into a brand new IRA account, and then I'm going to take that IRA and I'm going to immediately convert it over to the Roth. What the IRS does is, for tax purposes, is they now consider you to having one IRA account, even if it's split up into 2 accounts or even it's split up into 10 accounts. You have one IRA account balance, it's $106,000, and now they're going to use these pro rata rules to say that if you do a conversion of $6,000 over to a Roth IRA account, you're going to have to pay taxes on the amount of your taxable account balance as it pertains to the whole amount. So really it's going to be $6,000 out of a $106,000 account. That's the only portion of that that's going to be tax-free, and it's really going to mean that you're going to have to pay a lot of taxes on it. So it ends up being something that you really probably didn't intend on. But maybe you have an IRA account that you have out there, the traditional, but maybe your spouse doesn't. So maybe if you can't do this contribution to the backdoor Roth, maybe your spouse would be able to do it because they don't have an existing IRA account. So there's some options there. Another option that you might have available to you is something that we oftentimes refer to as the mega backdoor Roth IRA strategy. And it has to do with making an after-tax contribution to your employer-sponsored 401k plan. And it's something not all 401k plans have available, but we're finding more and more are having this option available to their employees. If you're not sure, just pick up the phone and call your plan sponsor and ask them if you can make an after-tax contribution over and above that $26,000 limitation if you're over 50, or the $19,500 if you're under 50. And how it works basically is it allows for some excess contributions up to what the actual IRS limitations are. So again, let's kind of look at an example here. Let's assume that you're under 50 years old and you can make that $19,500 contribution to either your traditional or to your Roth account. Maybe you're getting some employer match in there as well. Maybe you're getting $10,000 of matching funds. And what the IRS actually allows, if you're under the age of 50, is you can have up to $57,000 of contribution between your contribution and the company matching. So it gives you that ability to contribute, an extra $20,000 or so to this after-tax account. And according to a recent tax ruling in 2014, you now have the ability to roll that directly into a Roth IRA account. So the questions you want to ask is this available? Number one, how much can I contribute? So even though the IRS limitation might be $57,000 if you're under under the age of 50. And by the way, it's $63,500 if you're 50 years old or older. So it gives you, again, that $6,500 catch-up even for these excess contributions. So how much can you contribute? Even though the IRS might say you can contribute $57,000, the actual company might have their own limitations. Most often we see this sometimes capped at 10%. So you want to learn what those rules are, but that mega backdoor Roth IRA is one other option that might be available. And I kind of skimmed over the details of this a little bit quicker in this video. I think I do have other videos on the channel where I get into much more detail on that. And why I wanted to talk about all of this stuff here today is, again, talking about the retirement withdrawal strategy oftentimes really begins with where you save that money. And again, if we are talking about those three primary tax buckets, the non-retirement, the traditional, and the Roth, where we see a lot of times people making mistakes is they're maxing out maybe these other categories. We'll throw HSA in there as well. They're maxing out those other areas, and they're starting to accumulate more and more money in this non-retirement account, when in fact they really, along the way, they could be really taking advantage of some of these missed opportunities. The backdoor Roth IRA strategy, if they don't have any outstanding traditional retirement accounts, the mega backdoor Roth IRA strategy, or maybe they're not even putting money into their HSA and they're accumulating money over here. And one other recent video that I just recorded was talking about the net investment income tax, and that's something that is affecting more and more individuals. It's that 3.8% Medicare surtax, as they're sometimes referring to it, and it's for individuals that have modified adjusted gross income if they're married filing a joint tax return over $250,000, or if they're filing a single tax return over $200,000. Those numbers, by the way, are not indexed for inflation. They're going to stay that way, and so that means that a lot more people are starting to have potential issues with getting hit with this net investment income tax. So again, if we can get money into one of these more tax advantaged accounts, I think that's going to have a huge benefit. And especially if we're comparing a contribution to a Roth versus that non-retirement account, just hands down better. I mean, in both accounts, you're putting money into it on an after-tax basis, so there's no tax advantage going into them. But one, you have to pay taxes every year on the gains that you have in that account, the interest, the dividends, the capital gains, all of that stuff has to be paid taxes on every single year, versus the Roth, where you can grow and compound that on a tax-free basis and then take distributions out in retirement completely tax-free. And the last thing I'll point out about all of this stuff, we're talking about your retirement withdrawal strategy and how you structure that, but also too, another thing that we want to think about here is legacy. And this is something we do as a big part of our financial planning, is not only having the conversation about what your income tax brackets are today versus the future, but also kind of mapping out those total assets over your lifetime. And for most of our clients that we're doing these plans on, they're finding that, because of their lifestyle expenses and things, there's some projections maybe that there's going to be some money left over at the end. And so we want to think about your kids or your grandkids and what income tax brackets they're in if they inherit that. And one thing that did just change at the beginning of 2020 is they actually removed part of what was called the stretch IRA. So it used to be that if a non-spouse inherited an IRA account, they could stretch out the required minimum distributions over a lifetime. And if they're inheriting it, they're 40 years old or 50 years old, they could stretch that out over 20, 30, or 40 years potentially. Now, with this new law that went into effect in 2020, now they only have 10 years to distribute those assets. So again, it's another reason to go back and look at how your income, or how your assets, I should say, are going to be distributed between those three primary tax buckets. And again, that's one thing that we do as a big part of our financial plan. Wealth Vision is what we call it, and we'll put a link right below the video here today. So if you'd like to learn a little bit more about Wealth Vision and what it does or what it could potentially do for you, you can go to wealthvisionplan.com or click on one of the links right below the video. On that page, there'll be some information about how our financial planning process works. I think there's a video on that page as well. We just recorded the demo that should be going up here shortly as well. That'll have some more detail on what exactly you get out of that. But there's also a button there. If you like, you can click that and schedule a time to talk with me. It's a free introductory call. We call it a Creating Your Financial Vision Strategy call. So we'll spend a little bit of time understanding a little bit about where you're at and maybe some of your goals, and we'll talk about how maybe our financial plan could help you reach some of those goals. So anyway, those links will be all below the video here today. And with that, thank you very much for watching. Don't forget to hit the subscribe button, and I'll see you back here in one of our next videos. Thanks.